Starting to invest can feel overwhelming, but it doesn't have to be. And in this video, I'm going to be breaking down 5 of the most common ways people invest their money. I'll explain how each one works, and then we're going to be comparing them using 5 simple filters. How hard they understand, or the learning curve. What's the learning curve to them? Do they generate passive income while you sleep? How are they taxed? How much will you have to pay? How risky are they? And looking at their 10-year return. So if you invested $100 in them 10 years ago, how much would you have today? There's a lot of noise out there with stocks, Bitcoin, real estate. There's endless terms financially, but you don't need to know everything in order to get started. Now, a quick note, I'm not a financial advisor and I don't sell investments, and none of this is financial advice. You should always do your own research and your own homework. I'm a financial coach who helps people build confidence with their money so that they can live with more freedom and have less overall stress in their life. My goal is to post weekly videos with practical strategies to help you grow. And next week, I'm going to be covering how fast you could retire starting from $0. That's right. So don't miss that. Let's get into it. Let's start off with individual stocks. Now, this is what most people think of when they hear the word investing. It's like owning a small slice of a company like Apple or Amazon or Tesla. And yeah, it can be super exciting when the stock goes up. I personally bought stocks that, you buy them one day, they triple within a matter of a few months, but then they drop 80% just as fast. The problem is, if you don't really know why your stock's going up or why it's going down, at that point it's basically gambling. And without constant research and attention, it's mostly just guesswork. So the learning curve here is going to be super high. You've got to read earnings reports, you've got to understand how industries are shifting, follow financial news, and essentially treat it as if it's a part-time job. Now, passive income when it comes to individual stocks is also very low unless they pay a dividend. Otherwise, you're really only making money if you sell it for more than what you paid for it. As for taxes on individual stocks, they can be decent. If you sell quickly though, you're hit with short-term capital gains, which are taxed like your regular income. But if you hold the stock for more than a year, that's the key, or better yet, in something like a Roth IRA, but if you hold it for more than a year, you could benefit from long-term capital gains REITs, which they're taxed lower than what your current income is taxed, sometimes even 0% if done correctly. The risk level here for individual stocks though is definitely high. Even respected huge companies can collapse overnight with a single bad headline. Just think about Kodak, the camera company who invented the digital camera, but then they went bankrupt, or Nokia, who used to dominate mobile phones before smartphones took over. Both of these investment options would have been horrible over the last 10 years, but back then they would have been well-respected companies that would have seemed like a really good investment. Now, had you invested just $10 into the top 10 S&P 500 companies, that's $100, over the last 10 years, your return would have averaged 382%. That'd be worth $482 a day. $100 turning into $482, that's not that bad. So the 10-year results here are mixed. If you picked Apple or Microsoft, you've crushed it over the last 10 years. But if you pick the wrong horse, you could be down really big. And those might seem obvious today, but think about this. 20 years ago, 2 of the largest companies in the US were Citigroup and American International Group. They were in the top 10, but those have not done so hot over the last 20 years. So the bottom line is picking individual stocks is like trying to pick a winning horse in a race. It can work, but for most people, it's more of a gamble than it is actually a plan. That's where index funds come in. These are a favorite among long-term investors because they're simple and they're surprisingly effective. Think of it this way. Instead of betting on one horse, you're betting on the entire race. An index fund is like owning tiny pieces of hundreds or even thousands of companies all at once. And one of the most famous examples is going to be the S&P 500, which includes 500 of the largest companies in the US. Even Warren Buffett, the billionaire investor, says most people should just buy a simple index fund and hold it forever. Why? Because it works. The learning curve here is going to be super low because you don't need to research companies or time in the market. You just buy a broad-based index fund and let it ride. It's as close to set it and forget it as investing gets. When it comes to passive income, it's typically lower, but some index funds do pay dividends. But most of the growth comes from the fund's value increasing over time. Tax-wise, index funds are excellent, especially in retirement accounts, because they don't trigger a lot of taxable events. So that simply means that you keep more of the gains that you have in your portfolio versus not. Risk-wise, I'm going to say that they're moderate. They will go down in a bad year like 2008 or 2018 or 2022, but long-term they usually trend upward with the economy. Historically, the S&P 500 has returned about 7 to 10% annually. And that means if you invested $100 10 years ago today, your money would be worth about $281. It's not the most flashy, but it's powerful. One of my clients said it just felt so boring at first, so they ignored it for years. And finally, when they started again, they're seeing the growth potential without having all the stress. And that's the magic of index funds. Boring can be beautiful if you give it time. Next, we're going to look at gold. Now, this is one of the oldest forms of investing. People have trusted in gold for thousands of years. It's one of those things that you can hold and it doesn't vanish in a market crash. And it often feels like a really safe place during uncertain times. But here's the catch. Gold doesn't actually do anything. It doesn't generate income and it doesn't build products, right? Makes sense. And nor does it pay you. It just sits there hoping that you go up in value. It's kind of like storing a brick in a closet and just crossing your fingers that one day it'll be higher than what you bought it for. The learning curve here is going to be super low. You just buy it, you store it, and you sell it later. There's no major homework required, but as far as passive income, there's none. See, gold doesn't pay dividends or interest. You only make money if the price goes up and you sell. So tax efficiency wise, it's actually really pretty bad. See, gold is considered a collectible by the IRS, and when you sell physical gold at a profit, you're taxed at a flat 28% on the gains that you had, which is higher than long-term capital gains rates on something like stocks. Risk-wise, though, gold is pretty moderate. It usually holds its value over time, but it can swing based on things like inflation, fears, or changes in the dollar. And over the past 100 years, gold returns about 4 to 6% per year. Not terrible, but it lags behind stocks and real estate. But had you invested $100 in gold 10 years ago, you would now be up 168%, and your $100 would be worth about $268. Some investors keep 5 to 10% of their portfolio in gold as a hedge, meaning it's backup in case anything just tanks. One client that I had told me that gold just helped them to sleep better and it didn't grow much. And honestly, that's just fine. Just know what you're buying and why, and then you're good. Now, as you're hearing all this, I want you to be thinking about which one of these sounds like a fit for you and drop it in the comments because it might give someone else a helpful idea as well. I've had clients that tell me that they just waited for years because they didn't know exactly where to invest or where to even get started. But once we broke things down into these 5 investment types with these 5 different simple comparisons of how they stacked up against each other, something just clicked. They realized that they didn't need to just pick one either. And suddenly that kind of started to develop a plan. And that's exactly what I want for you. So with this next one, we're going to talk about real estate. And real estate gets a lot of attention and for good reason. You can see it, you can touch it, and it feels like a really solid path to building wealth. People picture themselves renting out properties, collecting checks, and building equity over time. But here's what most people don't realize. Real estate is rarely passive. You got to manage tenants, you got to fix things, you got to deal with property taxes, insurance, and maybe even answer the occasional 2 a.m. phone calls. The learning curve when it comes to real estate is actually really steep. You need to understand loans, laws, property management, and then cash flow to avoid huge financial mistakes that'll set you back. But let's say you wanted to get real estate exposure without the headaches. That's where something like REITs or a real estate investment trust come in. Think of it like this. You text 400 of your friends saying, send me $1,000 and we'll buy a building together. Well, that's basically how a REIT works, where everyone is going to pool their money together. They're going to buy a property and then they're going to split the income that comes off from that property. Now, you don't need a big down payment and you don't need to deal with any tenants. You just buy REIT shares through a brokerage, just like stocks. And so the learning curve on something like REITs is actually really low. You're not a landlord, you're an investor. And passive income is actually really solid when it comes to REITs. They pay dividends anywhere from 5 to 8% annually, but tax efficiency, that's a downside because they're taxed at regular income, which can often be higher than capital gains. Risk when it comes to REIT, I'm going to say is moderate. Now you're diversified across properties, but still things can affect you like interest rates and real estate market shifts. But here's something a lot of you actually might not know. REITs have actually outperformed stocks on a 20 to 50 year time horizon. But over the last 10 years, stocks have outperformed and REITs have averaged about 7.2%, which means $100 invested 10 years ago into a REIT today would be worth about $200. It had grown 100%. And again, they've kind of underperformed the market relative to stocks. But if you want to get into real estate without the headache, REITs offer a really good balance of growth and income without all the stress of those 2 a.m. phone calls. Finally, we've got crypto. Now, this is the wild card in the investment world today. It's the new kid on the block. You've got Bitcoin, Ethereum, Solana, so many others. They're all digital and decentralized and potentially game-changing. Some people have made millions with just a few $100. Others have lost it all super fast. It's a roller coaster for sure, and not everybody has the stomach for it. The learning curve on learning something like crypto is going to be moderate to high. You need to understand how wallets, exchanges, and blockchain technology work, and it's not super beginner friendly. When it comes to passive income, well, kind of. Some cryptocurrencies offer staking rewards, which are like earning interest, but it's not always super reliable. Tax efficiency when it comes to owning crypto is similar to stocks. Short-term gains are taxed like income. Long-term gains are taxed lower, but the IRS has tightened reporting rules lately. And risk when it comes to crypto, you guessed it, super high. It's still new, it's volatile, and it's driven by speculation much of the time. Prices can swing wildly over rumors or regulation. As for the 10-year returns, they have been massive, but they also come with massive risk. So if you'd bought $100 in Bitcoin a decade ago and held it, you'd be almost up $40,000 to $45,000. But many people, they're buying high, they're panicking, they're selling low. So if you're going to explore crypto, make sure you do your homework and only invest what you can afford to lose. But these are the 5 most common types of investments. You've got individual stocks, index funds, gold, real estate, and REITs. And then you've got crypto, each with their own pros, their cons, learning curves, and long-term track records. Hopefully breaking them down side by side like this helped you to see where you can start, and just know that you do not need to know everything in order to get started. You don't need to just pick one either. But doing nothing and picking none of these, that's the most expensive choice of all. And in our next video, we're going to explore how you can use these investment options to set yourself up for a fast retirement. And if you wouldn't mind dropping a subscribe, that way you don't miss it, I'd greatly appreciate it. We'll see you in the next video.